Today, I want to talk about how AMC could be about to wipe out the Fed and collapse the hedge fund industry. I want to explain how these algorithms shorted more and more shares of AMC synthetically, planning to force them into bankruptcy, just like these algorithms have done so many times before, but how actually AMC is about to become profitable, causing a hedge fund wipeout. So stay tuned and let's make some money. Now I want to dive straight in with the key information. So, NFT Happiness tweeted saying for the last 3 to 6 months, it seems Bed Bath & Beyond, AMC and GameStop has been setting up the mother of all bear traps. He said why, and because the short hedge funds and the Fed have lost control of the algorithms. He said for decades the algorithms worked perfectly, not just with AMC and GameStop, but with many other companies before like Sears, Blockbuster, Toys R Us and many others. These algorithms enticed retail investors and other institutional investors as well into buying these shares and then dropping the price and creating FUD, forcing them into selling their shares. They also cellar boxed the company effectively into bankruptcy, making it impossible for them to raise debt finance or raise any cash entirely until they went bankrupt, locking in these shorting profits forever with zero taxes. If they continue walking the prices of these stocks down, just like they did with Sears and Blockbuster, it effectively makes it impossible for them to raise new capital. They'd have to issue, say, 1 billion shares at 10 cents a share just to raise $100 million. Doing so would obviously dilute the existing shareholders, and it'd be practically impossible to sell out all 1 billion shares because not a single shareholder would want to buy. And obviously having such a low share price and likely being delisted from the New York Stock Exchange and from the Nasdaq also makes it impossible for these companies to raise debt finance as well. And that's why it worked incredibly well in the past with companies like Blockbuster, Sears, Toys R Us and many others. These shorts effectively hunted for companies with fairly slim profit margins or already existing loans, pushing the price down further and further, making it impossible for these companies to refinance those loans or raise any additional cash. However, the algorithms weren't designed to come up against buy and hold retail investors or investors that bought, held and DRS'd their shares and wanted to see their companies flourish. When the Apes arrived, the algorithms had no way to react other than continue doing what they were already doing, trying to push the price down even further, issuing more and more synthetic shares. And that's how effectively these algorithms had become trapped in an endless cycle. And the shorts and the Fed got so used to these algorithms working so perfectly, they got stuck as well, thinking at any moment the Apes would all of a sudden get bored, sell all of their shares, and then AMC and GameStop and Bed Bath & Beyond could go bankrupt freely. These shorts and these hedge funds became so overconfident and they believed there was no possible way the housing market would fail. That retail investors wouldn't sell their shares. They just continued to let the algorithms run because they knew at any moment these retail investors would sell their shares overnight. They knew that retail investors could never hold these shares for any more than a month or two, so effectively they continued shorting. And whenever these companies triggered one or more of any kind of negative event, it effectively forced these algorithms into selling more and more synthetic shares. When GameStop issued their 3-for-1 share dividend, these algorithms saw it as negative news and sold even more synthetic shares. When AMC announced the reverse split, more synthetic shares. When Bed Bath & Beyond announced potential bankruptcy, more synthetic shares. When they changed their stock managing agent over to Computershare, even more synthetic shares. But now we have a situation where if GameStop, AMC and Bed Bath & Beyond can get money or optimize the companies to become cash flow positive and then profitable, algorithms would be screwed. We know that actually GameStop is already profitable and that AMC is well on its way as well, likely to become profitable in this current quarter or maybe the next quarter. And these algorithms have sold short so many shares of AMC and of GameStop that these algorithms are likely to blow up the shorts and could potentially end up blowing up the Fed as well. And you see with the GameStop DRS pressure, the GameStop profitability, the AMC side pressure and AMC soon coming profitability as well, and the algorithm distortion by Bed Bath & Beyond, it's in danger of wiping out the Fed, the short family offices and the short hedge funds as well. Now, there is still some bearish sentiment about GameStop, calling the last earnings call a fluke and saying that it won't happen again. Basically saying that GameStop flukily became positive and profitable and will likely be loss-making again next quarter. But obviously when GameStop announces yet another quarter of profitability and AMC becomes profitable as well, it makes it even worse for these shorts. And he said this is actually playing out very similarly to how Tesla played out as well, for those wondering. And he said when GameStop posts their next earnings beat, the price should exit this bearish 2-year downtrend. And therefore people are also going to be anticipating the final nail in the coffin when GameStop joins the S&P 500. And obviously when GameStop breaks that downward trend, when it becomes still continually profitable, and when it joins the S&P 500, these shorts will be forced to close. The smaller shorts will first exit their position for a fairly small loss because they'll know at this point shorting GameStop is pointless. That will push the price up, that will effectively end up liquidating those larger shorts as well. And obviously when the larger shorts end up getting liquidated as well, at that point it pushes the price up even higher to the point where the largest of the large shorts that have created these synthetics get liquidated too. And as Bigham's tweeted, we know that many of these hedge funds are using the exact same strategies used by Archegos Capital Management. This is some confessions from family office members at Archegos that said Archegos used security-based swaps to gain exposure to these securities while concealing the true size of the fund's positions from the market and from our trading counterparties. And once Archegos gained market power in these securities, I and others used this power to trade in such a way as to artificially manipulate the prices of those securities. And he said I traded to increase the prices in names in which Archegos held long positions and reduce the prices of securities in which the fund held short positions. And he said I manipulated these securities in order to influence others in the market, like you and I, the retail investors, to buy or hopefully sell these securities in a way that would benefit Archegos' key positions and increase their purchasing power. So these hedge funds have built giant synthetic short positions to the point where they can control the price of AMC and GameStop, pushing it down as they so please to try and convince you and I to sell our AMC shares. But there will come a time when AMC and GameStop do not go bankrupt and become profitable, if they're not already. And at that point they can refinance their debt with no issues and issue new shares because us, the retail investors and other institutions out there, will buy those shares because they know the company is not going bankrupt. And it seems that actually, if anything, the Fed is going to bankrupt itself. Check out this video on Janet Yellen planning to increase the debt limit and increase the US debt significantly, paying even more interest every single day and every single month.
You're going to drive the debt from somewhere around $32 trillion up to about $50 trillion, correct?
Yes, but what I believe is the single most important metric for judging the fiscal stance of the country is real net interest as a share of GDP.
Okay.
We have
so are you concerned when
GDP.
you're taking the debt from $32 to $50 trillion? Are you concerned who's going to buy that debt, and also at what rate they'll expect to be compensated for buying riskier and riskier debt? Are you concerned about that?
Well, if the real net interest cost of the debt remains low relative to GDP, and we're on a sustainable fiscal.
Well, we're not on a sustainable path. You're going to drive the.
So Janet Yellen is planning to increase the US debt from $32 trillion up to $50 trillion, while the US is increasing the interest rates, and while other countries charge US an even higher rate for that debt, as the US is becoming riskier and riskier. So effectively, Janet Yellen is planning to pretty much bankrupt the US and bankrupt the Fed by paying more and more and more interest every single month. Not only is the interest rate increasing, not only is the debt load increasing, but the rate charged by other countries is increasing as well as the US becomes more and more risky. And Jamie Dimon himself is saying that people should be prepared for higher rates and for longer as well. So Jamie Dimon expects more interest rate hikes to come over the following few months, maybe over the next 6 months to even a year, and expects those rates to stay higher for much, much longer. Not only is that just the interest rates that are charged to you and I, but the interest rates the US is paying on its debt as well. And also the interest rate the US or the Fed is paying on those reverse repo and repo operation facilities. And on top of that, BlackRock has been instructed to sell $114 billion of the failed bank securities. So BlackRock is planning to dump tons and tons of debt and bonds and everything else into the market, potentially crashing or damaging the markets for these securities. Again, if the Fed is trying to bankrupt the US as fast as physically possible, they seem to be on the right track. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.